All right, everybody, it's Jerry Citarella. Jerry Citarella Presents. I'm here with another lesson, educational piece, inspirational, educate, inspire, and enlighten, whatever the heck it's going to be. Today, you'll notice I'm dressed pretty casual. I've got some jeans on, a nice little comfortable shirt, because sometimes you just have to relax. And that's part of what we're going to talk about today. I'm going to educate you about risk tolerance, understanding investments and how they relate to risk, what you need to do to control yourself when things get maybe a little riskier and a little scarier than you think. So relax. And today also I have my buddy Alex with me. If you've been watching these videos, Alex is my AI avatar. We're going to go back and forth and talk to him a little bit and kind of use the resources that are available. So let's get into the intro, come right back, and we're just going to go for it. Okay, so risk as it relates to investments is something that honestly most people don't truly understand. Everybody says, what's your risk tolerance? And when you work with an investment advisor, a lot of times they'll ask you some questions and they'll give you a number and say on a scale of 1 to 10, this is your number. And that all sounds great. And I've done a couple videos about this in the past and some educational stuff. But in reality, what does that really mean? All it means is based on your experiences and your education, this is where you're comfortable now. But the problem is a lot of people don't have really good experiences or education, so their risk may not be truly in line with reality or their perceived risk. Their perceived risk also may not be truly in line with what's necessary to reach their goals. So I just want to talk about that a little bit, go through it. This won't be a really long video. Well, I always say that it ends up being long. But first, what I want to do is I want to wake up my buddy here and let's kind of have a chat with him about some things. You'll see. And then we're going to go back and forth with him a little bit. I'm going to turn him on and off because he's AI. He's my avatar. I trained him. I built him. I talk to him once in a while, but he's still a little glitchy and he's got a bit of an attitude. He likes to interrupt me, but let's see what he has to say. So here we go. Hey, Alex, everybody's here to meet you and greet you again. And we're doing our video show. So can you say hello again real quick to everybody?
Hello again, everyone. It's great to see you all back here. Let's have a fantastic show together.
Great. I want to ask you a simple question, and I want you to define risk as it relates to investments and investment time horizons. Can you do that?
Absolutely. In the context of investments, risk refers to the potential for losing some or all of the original investment.
Oh.
It includes uncertainties about the returns and can be influenced by factors like market volatility, economic changes, and individual investment choices. When considering investment time horizons, the length of time an investment is held before taking profits or losses, risk tolerance and management become crucial. Generally, longer time horizons allow for a greater potential to recover from short-term market fluctuations, but also typically involve higher volatility and risk exposure. Balancing risk with the investment horizon helps investors achieve their financial goals while managing potential downsides.
Now, would you say not truly understanding risk or managing risk appropriately is a big issue when it comes to people's investment portfolios?
Yes, definitely. Not understanding or managing risk effectively can be a significant issue for investment portfolios. Here are a few key reasons why. 1. Inappropriate asset allocation. Without a clear understanding of risk tolerance and investment goals, investors might allocate their assets improperly, leading to either too much risk or overly conservative investments that don't meet their return objectives.
I see that often.
2. Emotional decision making. Investors often
Biggest
react
problem.
emotionally to
Biggest
market
problem.
fluctuations, which can lead to impulsive decisions that may not be in their best long-term interest. 3. Failure to rebalance. Proper risk management requires regular portfolio rebalancing to maintain the desired risk and return profile. Neglecting this can lead to portfolios becoming more risky over time. 4. Underestimating risks. Sometimes investors may underestimate the risks associated with certain investments, potentially exposing themselves to unexpected losses. Understanding and managing risk properly allows for more informed investment decisions, enhancing the likelihood of achieving financial goals while managing potential downsides.
Now, would you say it's fair to say that sometimes people just need to relax, understand their risk, understand their time horizon, not act emotionally, and again, just kind of relax a little bit? Is that important in its simplest form?
Absolutely. That's a key point. Understanding risk, having a clear time horizon, and avoiding emotional reactions are crucial for
Number
maintaining a
one.
sound investment strategy. Staying calm and consistent can help investors focus on their long term goals and avoid making impulsive decisions during market fluctuations. This patience and discipline are essential for achieving long term investment success.
See, relax. Okay, one last question for you. Can you tell me on average how often the stock market has a negative annualized return? I think people think it goes down more than it does. So what's the average time or how many
On
times?
average, the
The answer to the
stock
question.
market, specifically the S&P
I didn't know how
500,
to ask it.
has had a negative annualized return roughly about 1 in 4 years. Historically, the market has shown resilience and tends to recover over the long term. And historically, it has provided positive returns in the majority of years. The key is staying invested and having a long term perspective.
Great. Okay. Well, I'm going to turn you off for a minute. I'll get back to you in a minute. I want to explain a couple things. I didn't ask that question properly, but you
Sure,
answered it.
take your time. Whenever you're ready, I'm here to help with any questions or discussions you have.
There he goes. He always interrupts. But all right, Alex, we'll see you in a minute. Okay. So risk. Risk is something, again, that I think is hugely important, and it's a problem, I guess, understanding and accepting risk. And once you figure out what your risk tolerance is, build a portfolio based on that, sticking to it. I don't know if this is a word or not, but I've always told people one of the most important things in your investment portfolio is your stick-to-itiveness. I define that as your ability to stick to the plan. So let me show you a couple things here. I'm going to write on the board and show you some lines and some whatever drawings. We'll talk a little bit, and then we'll go back to Alex, kind of wrap this up, but I just really want you to understand it. So like he said, the markets go down on average about 1 in every 4 years. And that may be more or less than you thought. But within those time frames, there's also losses on a monthly, quarterly, daily, regular period. So there's always going to be that. But on an annualized basis, on average, going back a long time, it's about 20-25% of the time. We can go in more detail about how much it typically loses, how much it typically gains. That's a whole nother story. But what you have to understand is the market does indeed go like this. And obviously that's not an accurate drawing, but this is a depiction of what could happen. Now, when I say the market, I'm talking about the stock market. As Alex mentioned, a balanced portfolio, which includes other things like bonds and maybe some real estate, managed futures, and whatever else, different things that can build in some more stability in your portfolio, maybe some fixed products, high yield products, whatever it may be. Building a balanced portfolio that's appropriate for you to take on the level of risk in the most aggressive piece is what's most important. So it becomes what we call an asset allocation model, where you choose different things, different markets, different asset classes, we call them, to put in your portfolio. So in simple terms, let's just say you're someone that you want to make some money, but you don't want a lot of risk, and you just decide you want to go half conservative, half aggressive. Okay, that's simple. So you know that half of your money is going to be more volatile than the other half. The problem is that a lot of times people only focus on the more aggressive piece and think when they hear on the news that the markets are crashing, the world's coming apart, that they're losing all their money, when in reality, if your portfolio is set up correctly for you, you'll only be having those losses on half of the assets, not all of it, which gives you balance. And a lot of times when that piece is falling, the other piece is actually rising, and that's the benefit of asset allocation. But the majority of it is really just to bring you some stability, bring you some predictability. But here's where people go wrong. Oh my gosh, things are crashing. I don't think it's ever going to come back, even though Alex just told us it's going to come back 3 out of 4 years. People still freak out and unfortunately make very bad and emotional decisions. And many people will sell their investments right here or close to here and get out when it's down. Now, I get a lot of people that say, well, I'm going to do that while and see how it plays out. The problem is once you get out, it's very difficult to get back in. And I'm going into other avenues here, but I just want to touch on this because I get this a lot. Well, it's down, and I always say, well, if you didn't sell here, you're already too late. And people get scared thinking it's going to continue to go down. And I get that. But at some point, if you sell, and let's say you even did it right and you sold and it went down a little further, well, now you're stuck. Your feet are in the sand, your feet are in the mud and in the cement. You're not going back in, because what will happen is the markets will come up a little bit and you'll think, oh, this is the time to get back in. And then they'll come down and you say, oh, I'm glad I didn't get back in. And then at that point, no matter what happens, you're not going to be able to decide what's the right time. And I say this as if it's a guarantee. Nothing's guaranteed, but I've seen this a lot. And then what typically happens is the markets start to recover pretty aggressively, because that's not uncommon. As I'm giving this talk, as I'm doing this video, we actually just had a really big market recovery after some losses at the beginning of the year, 2025. So when it starts to come back, then you go, well, now it's up higher than I'd like to get back in. It's going to come back down. I know it will. And before you know it, it takes off and recovers, and you ultimately sold here and then maybe get back in here. So I can draw all kinds of lines and squiggles and stuff, but the basic concept of it all is that you truly have to understand what your risk tolerance is. And again, that's all based on education and experience. And I love to say that because so many people have one or the other or neither. And so many people only have a bad experience. Well, I had money in the market in 2008 and it got crushed and I took it out and I never want to do that again. Okay, well, that's your experience. And that's what we have to start with as good financial advisors, as financial planners. But some other people will say, well, I had it in 2008 and boy, I almost sold it, but I decided to stay in and I've made so much money since then. I totally understand the benefits of just staying in the game and holding long term. Okay, same time frame, same opportunity. Somebody's experience was very different than somebody else's. So as advisors and for yourself, you have to understand kind of where you're coming from. And then the next thing is education. If you had a bad experience or no experience, the only way that you can become more comfortable is through an understanding of how these things work and educating yourself, or having somebody like me, a very casually dressed financial advisor, because remember, this is the we need to relax video. Relax mode is on. Having someone like me help you understand what risk truly is, how to manage it appropriately for you, not for me, not for anybody else, not the guy behind the cameras, for you, because your plan is yours. And nobody can tell you, like they do on TV sometimes or on the radio, this is how you should build your portfolio. Or the people that are on social media like I am right now saying, this is how you should build your portfolio. Just buy these index funds and this, and hold it for a long time. That all sounds wonderful, but you're you and you have a plan that makes sense for you, your family, your needs, your desires, and your goals, and you have to plan that accordingly. But the main priority here is once you set it up, understand the timeframes, okay? And have them in place. I have a portfolio that I'm going to look at every year to see how it's doing. And if it doesn't do at least this, then I'm going to make some changes or be concerned. Or I have a portfolio that's more aggressive and I know 1 in every 4 years I'm going to lose statistically. And if that happens in the first year, that's going to be a bummer, but I need to stay in. Otherwise, I don't get the opportunity to get that recovery, and the recovery's typically pretty nice after especially a really bad year. So you need to set it up properly. You need to understand your time frames, your risk tolerance, your goals, what the heck you're doing, and then find your stick-to-itiveness and see how much you can handle and just stay in the game for that time frame. Now, this is not me guaranteeing you that no matter what you do, every time frame, as long as you stick to there, there's going to be success. Obviously, we're dealing in a world of unknowns. But if we can go back in time and look at the history of things and all of the things we've gotten through, I've been in this business now, I think 32 or 33 years. We like to say, I don't have 32 years of experience. I only have 4 years because I've been through 4 recessions. So that's kind of how we look at it. How do you survive the really, really bad times? And those are actually the meetings I love with my clients, because I get to bring them in and explain what we're doing, how we're doing it, how we're going to get through these bad times and keep them in to enjoy the better times. So even if you do nothing, historically staying involved, if you didn't get out prior to the dip, is the play, is the game, okay? But just understand, risk tolerance is determined by, again, the time frames you have to invest your money, your experiences, but it doesn't mean just because you have 10 years or 15 or 20, you're going to be okay being aggressive. What's your risk tolerance? That's the important piece. Where do you stand? What can you handle? Think of it like whitewater rafting. I'm good on a level 3, 4, maybe, slight risk of maybe going in the water and having some big issues. Other people just want to meander down a little mild little, bubbling spring or something, whatever the heck it is. But you understand it. When you get in the car, how hard do you hit the gas? How far do you twist the throttle? What do you do? Are you a skydiver or are you a teetotaler? And all that really affects how much you can handle. And you have to understand that, because the best plan doesn't work if you don't get to the end of the plan. Okay, so that's kind of enough on that. I'm going to see if Alex has a question for me that he'd like to ask about risk, and I'll see if I can answer it, and then we'll sign off. And if you don't mind, subscribe, share, like, do all that good stuff here on this video, and we'll have some more coming in soon. So let's say hello to Alex again and see if it has a good question to test me. Hey, Alex, it's me again, Jerry. We're still talking about risk tolerance as it relates to investments. And I'm wondering if you have a question for me that I can answer about risk tolerance that you think would be important for people to know.
Absolutely, Jerry. A crucial question about risk tolerance in investments would be, how do your financial goals and time horizon influence your risk tolerance? This question helps to determine how much risk you're willing to take on for your investments, based on what you're aiming to achieve and the time frame you have in mind.
Gotcha. And I actually kind of already answered that, and that just shows that AI thinks that's the most important question to ask, and we've already covered that about understanding your risk tolerance, your time frames, your goals, and really just having a clear understanding of it. He's probably going to interrupt me in a second, but I'm just going to keep talking anyway. So I will just reiterate, make sure you understand what you can truly handle and use the number things. Where do you stand on a scale of 1 to 10? How much are you willing to lose? What do you want to gain? All those things you'll see in a traditional risk tolerance questionnaire, but really understand where you are. And then please, 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 like I'm dressed relaxed today, when things go wrong.
You're absolutely right, Jerry. Understanding your
Okay,
comfort
we'll let him
level with
talk.
potential losses and the returns you're aiming for is key. It's about finding the right balance that aligns with your goals, comfort level, and investment horizon. Regularly revisiting and adjusting your risk tolerance as your situation or market conditions change is also very important.
Or your experience changes, definitely. Okay, Alex, I'm going to turn you off, but can you say goodbye to the people and say, I hope you enjoyed the show, and then whatever final message, give us something inspirational.
Of course. Goodbye, everyone. I hope you enjoyed the show. Have a wonderful day.
You know what? Give us an inspirational life lesson type of message before you sign off. How does that sound?
Absolutely. Remember, life is a journey filled with both challenges and opportunities. Embrace each moment with an open heart and a curious mind. Learn from your experiences, cherish the connections you make, and always strive to grow and persevere. The path you choose today shapes the person you become tomorrow. Stay positive and keep moving forward.
Thank you very much, Alex. That was a great message. And with that, we're going to sign off. See you on the next show. Thanks for coming. Jerry Citarella Presents. Subscribe, like, all that stuff I said. And he's probably going to say goodbye one more time and interrupt me. But either way, we'll talk to you soon. Talk at you soon, technically.
I'm glad you found the message meaningful. Thanks for the warm words and the great conversation. Wishing you all the best and see you next time.
Love this guy. Like, subscribe, share. Talk to you soon. Have a great day. Have a great life. Be well.